He's Brian Levitt, Invesco Chief Global Market Strategist, $2.2 trillion in assets under management there. Okay, Brian, we're seeing a sell-off, but barely. It's not a huge amount that the market is getting clipped from, and there's some serious actions here. So what does that tell you to tell your clients right now about diving in and buying more stocks?
Well, the first thing I'd want to do is take a giant step back and look at whether the cycle is likely to continue to persist. So you've got a couple of things going against you a little bit in those indicators, but the core indicators still remain strong. So when I say that inflation expectations ticking up a bit, right? Not ideal. Fed, we've had to back out the rate cuts. Are they going to have to raise rates? Probably not. That's usually how cycles end. Yep. Credit spreads have been behaved, as you mentioned. The dollar has not been rallying significantly. If anything, the dollar's weakened for the most part over the last few weeks. So you look at all that and you say, it's a cycle that's likely to continue. What we have right now in the short term, the direction of the economy shifting from what looked like a global expansion and policy easing to a slowdown in economic activity, given $4.50 gasoline and the rate cuts off the table. So it's a little bit of a sea change in leadership.
Okay, what slowdown in economic policy, economic numbers, et cetera. I'm not sure I really see that. Where do you see that? Because we have durable goods numbers holding up mostly, but again, I guess you would see that the costs are going up.
Yeah, I wouldn't say you're seeing it in the data yet. It's actually been a very resilient economy. And I remember coming into the year saying to investors, if you don't like this environment, I don't know what to tell you, right?
Do these people not remember the COVID pandemic?
Yeah, I mean, this felt like a really great environment. So we've disrupted it for the second year in a row with some policy decisions. I believe we'll get through it. I think the market's going to be more positive a year from now. But what you're going to start to see is some slowdown in activity. I mean, it's just what happens with $4.50 gasoline nationally.
But what are the odds that we would then see that paired with a rate cut? I mean, what do you see in the bond market right now that you don't love so much?
Yeah, I don't love seeing, well, for one, I don't love seeing the 5-year break-even rise into the 270s. So the bond market's expectation for inflation is clearly rising. As you mentioned, that has the short end up, the 2-year, the 30-year above 5%. So
yeah,
directionally,
show the 30-year. That went above 5% today, and that I think is something that explain to viewers why that matters.
Well, it's critical because you're starting to get to a point where the bond market is becoming more concerned about inflation, and that's how the cycles end if you start to worry about inflation and the Federal Reserve has to raise interest rates. There's this old line that none of the market cycles die in bed of old age. They're all ultimately murdered by the Federal Reserve with interest rate hikes. And so that's what you want to watch. Are we over-levered? Are rates going up? Are spreads widening? Are the bankers tightening lending standards? Most of that is not happening. The inflation numbers are a little disconcerting, but it's a price shock. I don't think it's sustained inflation.
All right. Tell me what you recommend people buy right now.
Yeah, so in a short-term slowdown, you want to be focusing on larger cap growth. You're seeing it right now in the numbers. You're back to a little bit of a growth in a slow growth type of world. Now, we came into the year saying you want to own emerging markets, you want to own small and mid because we have a global expansion, we've got policy easing. We're disrupted on that a bit in the short term. Ultimately, I think you're going to want to get back on that trade, look for signs of resilience in the economy. Can the Fed step back and ease? The other thing, I don't think interest rates are going to stay here. And I would start to look at these 4.5 on the 10-year, 5% on the 30-year as very attractive opportunities. Again, you put a spread on that to get you into munis credit, very attractive.
Yeah, you get nice yield, certainly. Good to see you. Thank you for coming.
Absolutely. Thank you.
Brian Levitt.